steps to how to trade cryptocurrencies, a very, very hot topic in the trading community now. As always, trading foreign exchange on margin is not indicative of, I'm sorry, past performance is not indicative of future results, and trading foreign exchange on margin or CFDs on margin carries a high level of risk. So I ask you to read the disclaimer very carefully to understand all the risks associated with trading on margin. Seek advice from an independent financial advisor, as always. Topic of the day. I think at this point, everybody and your grandmother has heard of cryptocurrency. We've had our huge tulip mania blow off, and the market has certainly calmed down a lot recently. But I think the most interesting thing about this market is how it's actually stabilized. Many skeptics, including myself, and I was probably one of the bigger skeptics, and I still remain a general skeptic about the overall technology, but I respect very much the trading instrument as it stands right now. I think many skeptics just simply expected this thing to go away, and clearly it's not going away. I think the number one takeaway from the presentation today is that cryptocurrency is here to stay. Whatever format it takes, whatever form it will have 2 years, 5 years, 10 years from now is unknown. But I think the idea that this is just simply a flash in the pan and that it's going to go away is not, because the structure of kind of a distributed, highly flexible, secure, anonymous transactionality is very valuable. And there's a million, actually, ironically enough, we can talk about this a little bit later. There's sort of a million use cases for the technology of cryptocurrencies within finance itself, which could be very disruptive to a lot of financial institutions. So we can talk a little bit about that. But I think the first and most important thing to establish is, will this disappear completely? If you're sort of a crypto bear, which I was for quite a long time, the ultimate judgment is that this goes to zero. And I think that is not the consensus you could come to right now. I think, in fact, it's quite the opposite. That it's been durable, it's been tradable, it continues to be tradable, and as an asset, it is going to be part of our repertoire probably for the next 10, 15, whatever years that we can look in the future. And that makes it a very interesting asset for us to consider, irrespective of its short-term or long-term volatility. So that's the first point to make about cryptocurrencies. I think it's just simply here to stay. At this point, I think there's very little doubt that that Bitcoin, Ethereum, and all the other cryptocurrencies are going to just simply disappear into nothingness. They are not the .com stocks of 1999. They're not pets.com. I guess that's what I'm trying to say. I guess that's sort of the ultimate binary question. Is it pets.com or not? Those of you who may be too young to remember that, there was a website called pets.com, which was supposed to sell goods for pets, which ultimately, ironically enough, is a big enough business now on the web. But of course, too early and too soon. And it was a multi-billion-dollar valuation company that went to obviously zero, and it was always used as a moniker of just the ridiculousness of the .com bubble. But the bottom line is, even out of .com bubble, we got Amazon. And Amazon now is one of the most valuable companies in the world. In fact, it will probably be the most valuable company in the world. So you could make the same kind of analogy here, that out of the ashes, there will be things standing. And that is really the ultimate question that we have to answer first and foremost. Is crypto here to stay? I was being very clever like a couple of months ago where I was said to everybody on Twitter, hey, is crypto kryptonite? Which I thought was really, really clever for a second. But the answer, I think, honestly, from a skeptic like me, is that it's not. It's not. That it's an asset that is truly popular. So why is digital currencies so popular? And I think there's multiple reasons, of course, for it, but primary is the anonymity and transparency. Those are things that we've never had in an asset. An asset essentially that is not invested with any kind of government authority. I think a lot of people find that extraordinarily intoxicating and very valuable. But more importantly, that it's not invested with any kind of authority, meaning that you don't have to have an issuing body, a Australian Stock Exchange, a New York Stock Exchange, a Bank of England, a European Central Bank issues the asset behind it. It's simply issued by the consensus of the group. That's a completely new paradigm. And I think that is probably the single most attractive thing about it, is that it's non-controllable by any single entity. Therefore, that in itself is a tremendous value to people who look at crypto as an alternative asset. So freedom of payment, anonymity, transparency, obviously no government oversight. But and even governments. So it's interesting. So I was saying to Fabian earlier, I have been a tremendous crypto skeptic, because when you look at the sort of the core essence of what it's about, is essentially a spreadsheet in the sky, right? It's a distributed ledger in the sky. But when you put it that way, it sounds very, very mundane. But the end result of it is that creates that sort of non-centralized control authority. Just that one little aspect of it is what creates tremendous possibilities for lots of different things. And the interesting thing is that governments, which everybody was fearing would actually try to outlaw this thing, are now coming around to the idea that this could be very, very useful for, this is the irony of the whole thing, governance of citizens, right? Yesterday, there was a massive, massive hearing in the US Congress. Lots of crypto experts were testifying. And the general tone from legislators was extraordinarily powerful, was extraordinarily accommodating, because they actually want to incorporate a tremendous amount of things. Because remember, the irony of the whole thing is, in democratically elected states, the government actually does not want the tedious centralized authority, right, of doing everything for the citizens. If it can enable citizens to do things for themselves, it first of all is incredibly efficient in terms of cost structure, but it also offloads a lot of errors and mistakes from government's books. A very, very common use case that everybody brings up, and I think it makes tremendous amount of sense, is land registry, right? Everybody across the world, all sorts of lots of land and real estate properties and stuff like that are locked down in centralized databases that are incompatible, sometimes non-transparent, sometimes not even existent. And imagine if you had a situation where title to anything, title to a car, title to a house, title to anything that you own, could be immutably recorded and available without any errors for everybody else. So, there's just a sort of a million different things like that that make the government actually very, very excited about the idea of blockchain and cryptocurrencies. So what are cryptocurrencies used for? Now they're used for, they're used for a million sort of different things, or at least they're presented to be as used for a million different things. But ultimately, for our purposes, and really for real life world purposes right now, right? They're just simply assets. You can make all sorts of grandiose claims about, hey, we're going to have digital cash and quick settlement and stuff like that. Nobody in real life uses crypto as a currency, right? Nobody does that. And in fact, I would argue that's probably the worst case scenario for crypto to be. Crypto, certainly the way Bitcoin is designed, crypto is a horrible currency, precisely because it is exactly like gold. Now, those of you who are gold bugs could furiously disagree with me, but 150 years of monetary governance proves me right and proves all of you wrong. In a sense, what I mean by that is that money is a completely fictitious entity. Money, as we think about it, does not exist. There's no such thing as hard money. Money is as imaginary as the thought in your head, because the money that you think you have in the bank is not money. It's simply a digital transaction that, by the way, is utterly manufactured out of thin air, right? Now, that's certainly unfair when you think about it. We work so hard to get money. We put tremendous amount of labor and service and value in whatever we do to get money. But the actual money that we receive has zero value and can be created out of thin air, and is in fact created out of thin air continuously. And it has to be that way. It has to be that way. We have to live this fiction in society because we need credit, right? The reason why money is created out of thin air is because we need credit. Credit is created out of thin air. Bank takes $1 of your money and then creates at least $10, and in some cases $100 worth of fictitious money, which it then gives out to everybody else, which they use as though it's real money to go buy real things to go invest. And that is how economies grow. And that's what we need in order to be able to sustain boom and bust cycles and all the other things. So I don't want to get into too deep into Keynesian economics, but the bottom line is that the reason why we haven't had a Great Depression since 1930 is precisely because we don't use gold as money. And for us to go back to that idea would be like for us to go back to the Stone Age and live in caves. So if you sort of understand that money is a fictitious entity, then you can't use crypto as an idea of money, especially with the constraint that crypto has in it, which is that it doesn't, it has a limited use. There's only going to be 21 billion Bitcoins out there. So that by itself, I think, makes the idea of crypto as a viable currency kind of non-starter. What it is useful for is a sort of a digital asset, right? And it's a digital asset in the same way that any kind of asset is used for. The best way to think about it is people feel it has value, right? Feel. The key thing here is that they feel it has value. Now, what does that mean? They feel it's the exact same thing as the Van Gogh painting, right? If you think about it, when Van Gogh painted, he couldn't sell a single one of his canvases, right? If you could go back in time, what's the single greatest trade you would make? You'd go back to Paris and you would, in the 1800s, and you would buy up every single Van Gogh canvas you could and sit on it, because now they are the most valuable canvases in the world. What has changed? Has paint changed? Has the art changed? Has the view changed? Nothing has changed. Feeling has changed, right? It's art is an asset the way crypto is an asset. It's because people feel it's valuable. So in that sense, I think that's how you have to look at Bitcoin and all the other assets as a thing. You can see Kathy did this presentation. It's woefully out of date as far as prices. So what are the risks of digital currency? There are multiple risks, and if any of you have traded it, I'm sure you've suffered some of the risks. And actually, my key takeaway from today's presentation is I think that if you are going to trade it, we'll discuss this in much more detail, but if you are going to trade it, the only way to trade it is through Pepperstone. And I'll explain to you why, because they're going to mitigate almost all of these risks that are present here. So volatility, that's obviously something you can't mitigate. Volatility is just a natural aspect of the currency. It's not regulated. It's irreversible, right? I think the single greatest irony of cryptocurrency, and it certainly gives a lot of schadenfreude to crypto skeptics like me for a while, was this. The biggest argument was, hey, we have this beautiful distributed anonymous asset that nobody can control, right? What's the first thing that we do? We buy the asset, and then we put it into this centralized single point of failure exchange where it's all controlled by one point of failure. And anybody could basically dip into that exchange, extract our asset, and we never have any recovery. There is no trace. It's totally anonymous. It's like cash, right? Basically, I have $100,000 worth of cash. I put it in the middle of a street. I turn around and it's gone. What's my recovery possibility? Exactly zero. You know, if I have a $100,000 charge on my credit card and I don't like what I got, my recovery possibility is about 100%, right? So the irony of the whole thing is this whole distributed notion failed miserably in actuality because of all of these exchanges. I'm actually curious, anybody who's listening to me right now, feel free to type it in. Did you guys trade on these unregulated exchanges? Have any of you been hacked? Have any of you come, you know, if there's stories of woe, I'd love to hear them, because, you know, they've been much more common than most people believe. The bottom line is, it's like carrying, would you ever consider taking all the money out of your bank account and just carrying it in your pocket and saying, hey, that's my net worth over there walking around with me? How safe would you feel? That's pretty much the idiocy of trading Bitcoin on all of these exchanges across the world, because it's effectively what you're doing. They're all vulnerable to hacks. You know, they're also actually terribly illiquid for most of the time. And of course, the other big thing was government bans, which was something that swept the market for a long time. What's interesting right now is notice that even sort of ardent critics of these things, like South Korea, China is still a separate case, but South Korea, which had a huge amount of Bitcoin flow coming through it, and try to ban the exchanges, are not coming around to the idea that, you know what, we can't ban this. This is bigger than all of us, and we need to control it. So we need to regulate it. And I think, you know, the movement now is away from banning to much more regulation. It's interestingly enough, I wonder if the Chinese are going to come around to it. But, you know, in some ways, this desperate desire to control every aspect of a citizen's life through technology is really gets subverted by crypto. And I wonder if the Chinese are going to have to bow down to this idea. So, you know, the story kind of, I think everybody knows the background. Bitcoin was invented 2008. The process for how this works is pretty complex, and I'm not gonna torture you with the flow chart of how it works, but just sort of imagine that it works in the cloud. It works in a highly distributed fashion with computers all across the world that are just checking the same transaction by all computers is being checked all the time. And then when everybody comes to an agreement, it's kind of like imagine, you know, a democracy by consensus. Everybody has to agree that this deal is good, make a vote, and then verify that the deal is good, and then the asset is verified, and you move on. So that's how you know that what it is that you own is truly, genuinely verified, and therefore good. Of course, in the computer land, you know, it's microseconds and milliseconds. But ironically enough, because this has become such a popular and such a difficult game to do, the validation process is extraordinarily slow at this point. One of the basic reasons, one of the absolute reasons for why Bitcoin is never, ever going to be a currency is because it takes, I think you can only do 7 transactions per second on a validation base now, and it's probably going to be even less than that. Contrast that with, I think, 25,000 transactions per second. Per second, we're talking about per second. Maybe 25,000, and probably going to go to 50,000 per second for Visa, MasterCard, and all of the, you know, digital networks in the world. I mean, you need to, and there are, you know, believe me, there are people coming up with solutions that are creating other cryptocurrencies that don't have this huge overhead of validation. But, you know, it's a chicken and egg thing. If you don't have peer-to-peer validation, if you have just if you don't have distributed validation, but even just peer-to-peer validation, the quality of your validation kind of goes away. It's a problem that a lot of people are working on, but I still think that ultimately the idea of super fast transactionality will probably play itself out in other different structures of cryptocurrencies. But as generally as a medium of exchange, I still hold that out to be a more distant possibility than as simply as an asset. So, you know, what about mining? I'm actually curious, Fabian, has anybody in the room tried to mine cryptocurrency? Let's see how hardcore our audience is. Is somebody say yes to me? Is anybody saying yes in the room?
Yeah, we've got a couple.
Okay, so that's interesting. So, and now my second question, follow-up question is, did you make any money out of it? Has that been a profitable venture? Um, because, you know, the story of mining has always been the story that the guy who sells the pickaxe, this guy, and the guy who sells. By the way, did you guys know that Levi's jeans? I had no idea, but Levi's jeans was actually started by selling, you know, these very durable pants to miners. That's how the company became so rich. So my point is that whenever, you know, whenever it comes to mining, whether it be physical or digital, the people who really make the money are the ones who provide the tools. And the reason why is because it's extraordinarily expensive at this point to kind of do anything meaningful. Let me just show you using the Bitcoin mining calculator. I'm going to use just simply the most ridiculous examples possible. So hash rate of 100. Remember, I'm right now running my presentation on a MacBook Pro, which is about 2.7 gigahertz power, right? So here I'm inputting 100 gigahertz hash rate into this thing using the current Bitcoin rate of about almost $10,000 per Bitcoin, and I'm not charging myself anything for electricity. I'm literally now. I live in New York City. I happen to have a great deal on my apartment where I don't get charged anything for my electricity. That's why I can run like 8-9 screens in my house. But even with that ridiculous example, you can see that the profit right now at these current prices and the amount of the amount of computer power you need to really actually meaningfully mine, you get a whopping $34 at zero cost, zero realistic cost. So I think mining is not the way we can make money in Bitcoin at this point. That party has passed. But people who've mined, have they made any money? Fabian, I'm just curious.
A lot of people saying yes, but maybe different cryptocurrencies.
Okay, yeah, and that's a fair point. That the other cryptocurrencies that don't have nearly as large a following and a lot of overhead may provide, kind of like penny stocks, right? They provide new opportunities for possibility. But the more established one certainly becomes a much more bigger challenge here. So you have hardware failures, power outages, network disconnections. I think mining is just, as I said, not a way to go. So how do you buy cryptocurrencies? And I'm here to really dissuade you tremendously from buying them in any other way, shape, or form except from Pepperstone. And I don't say that just because I'm doing the presentation of Pepperstone. And I could, and I will say, just in sort of to be editorially honest, I could say the other way that I recommend that you would buy the cryptocurrencies is through the Chicago Mercantile Exchange or the Chicago Board of Options Exchange, both of which trade Bitcoin futures, right? The one trades five lot, the other one trades one lot. And the reason why I simply say that this is the only way to really participate in it is because you have the single greatest element of risk eliminated, which is counterparty risk. Every one of these exchanges, Coinbase, Blockchain, BitGo, whatever, everyone has been hacked. Every one of them is essentially a centralized platform on which you deposit your money into, and therefore there is no one to guarantee the safety of your funds. When you are trading with Pepperstone, which is obviously a very trusted counterparty, you're trading a virtual cryptocurrency, just like you're trading a virtual euro, just like you're trading a virtual yen. Like, this is the other thing, is we need to sort of, get away from the idea that it matters whether something is virtual or real, because what's real is price, right? Ultimately, what we trade is price. It really doesn't matter whether it's Bitcoin, yen, euro, or anything, or ASX 200. It's price that we trade. And as long as price is, as long as there's fidelity in price, as long as price is legitimate, it's much better to trade it with a counterparty that is almost ensures that your settlement and transactions are going to be done. So yes, you can go to all of these crypto exchanges all across the world, and most of you will probably be fine. But that's not the question. Isn't that that you're going to be okay? The question is, the one time out of 100 Are you not going to be okay? Will you lose all your money? It's, do you want to take that risk? I certainly don't. That's why I would never trade with anybody but Pepperstone or the Chicago futures exchanges, which are very, very legitimate counterparties. So the top 4 cryptocurrencies, and then the list has changed. Obviously, you could talk about Ripple. I'm not going to talk about Ripple today. It really doesn't matter, as I said, because what we're going to talk about today, as we get into the presentation, is how to trade all of them. It really doesn't matter whether we're trading Bitcoin, Ethereum, Dash, Litecoin. As I said, for us as traders, what we really care about is price, right? The foundational ideas here, I think, are very interesting for us to discuss, and I'm happy to take any questions. I'm certainly happy to have you guys challenge all of my views on this. But ultimately, what we care about is, and I would hazard to say that if Bitcoin was $1 from 2008 to now, none of us would care. It would be an interesting theoretical concept. We'd all be talking about how wonderful, how we can have flying cars in the future. It'd be the flying car of digital currencies, but nobody would really care, right? Kind of like nobody really cares about electric cars until Elon Musk can actually produce, and that's a big question, and they can actually produce a usable electric car for a reasonable amount of money. It's all wonderful, but we all want the actual real life experience. And the real life experience is that it moves in price, and that's the key thing. So we're going to focus on price on all of these things as far as we go. And you can see market cap has blown up tremendously. All of this stuff is a little bit outdated because Kathy's presentation, they're much, much larger in some ways. The key thing here is to just simply understand that the market is very dynamic, very organic, and pretty much here to stay, in my opinion. So investing versus trading digital currencies, this is an interesting thing to think about. There are people who just, and maybe the people who are miners in the room are of that persuasion. They're like, I'm not here to trade it. I'm here to just buy and hold it, because I saw today some guy who was a big crypto guy said he thinks it's going to 40,000. Maybe, I think if it does, it's not going to happen this. He said it's going to 40,000 this year. I think zero chance that happens this year. I think the mania part of crypto has kind of passed us, and as we get into much more of a mature market, the rate of change is going to be much more sedate, and that actually is in some ways is good because it will while it would dampen volatility, it will also create longer and better trends for us. But cryptocurrencies on a valuation basis are impossible to value. In the same way that gold is impossible. Let's put it this way. Bitcoin is even worse than gold, right? Gold intrinsically has a modicum of value because I guess you could put it into your computer, and you used to be able to put it into your teeth, and it has some industrial use, and it has obviously some use in jewelry, right? So there is some intrinsic value to the product. So you mine it for X amount of dollars, and if you make jewelry out of it, people are going to pay you X amount of dollars, right? But from an investment point of view, what makes when we look at typical financial investments, what is the key thing we all look for when we do valuation? That's yield. Yield is basically cash flow. We have an asset that produces cash flow, and that cash flow is then either returned to us in the form of a yield on a bond, a dividend on a stock, or plowed back, and the equity of the company grows, and the company makes more and more cash flow, and that's how we get valuation. None of those dynamics are present in any cryptocurrencies. They are like art, much more than they are like a stock or a company. And before everybody tortures me with ICOs, let's just say that I'm not going to talk about ICOs, which are the biggest scams in the world, and which are not, by the way, initial coin offerings are basically a variant of crypto in crypto land, where people give you a token, right? They give you buy a token in the hope and promise that this token is going to be worth something down the road. But a token is not the same at all as a share in the company. You're not buying the ownership of that business. That business is basically scamming you. It's saying, here's if I gave you if my little daughter, my 5-year-old daughter, cut out a penny out of a piece of paper, right? And I said to you, here's a Boris token, and I'm selling it to you for $1,000 because someday I'm going to be a famous guy who's going to be worth a lot of money. You'll buy that, that piece of paper. But in the end of it, even if I am a famous guy worth a lot of money, all the money comes to me. That piece of paper is all you got. So let's not even talk about ICOs for the time being. But the point is, valuation-wise, I just want to make sure this is really, really clear. There is no way to value cryptocurrencies. They have no yield, therefore they're invaluable. Not non-valuable, but invaluable, if there's a word like that. Is there a word like that? I have no idea. So is that clear? I just want to stop here for a second, make sure everybody is on target with me about that. Are we clear on this, Fabian? Any questions?
Yes and no. There's one big question. It's more about the cost. So for holding on an exchange, you buy your coins, you can hold it there for as long as you like and hopefully make money. Whereas if you trade as a CFD, there's obviously ongoing costs like a swap rate. People are just wondering if the cost of holding it is higher than the opportunity cost of being able to short sell it. Does it sort of provide a much better cost to trade it or just to hold it because people have to pay more?
Right. So this goes back to the idea of investing versus trading. Let's just let me come back to this just for 1 second. This is a great question. Great question. Because let's talk about dynamics of what we're doing, right? If you are a hardcore crypto guy who says, Bitcoin is going to 50,000, I'm just going to hold my little Bitcoin, right? Then there's zero reason for you to go to an exchange. What you do is you go buy your Bitcoin, you go like bury it in your backyard with your little, your little digital stick, because it's the only way you can ensure that somebody isn't going to steal it, right? I know there's all sorts of third-party, vaults now that are coming up and stuff like that. All of them are still, if it's in the cloud, it's penetrable. Okay, trust me. If it's on a computer that you don't own, somebody can penetrate you and take it away from you, right? So, and by the way, this goes for fiat money all the time, right? I mean, like banks get hacked all the time. The difference is banks are good for it. I'm actually curious. Anybody have money stolen from your account? I have had that happen. People just bang out a couple $1,000 out of your account, whichever way they manage. The bank is always good for it. It comes back and drops the money back in your account. The exchange isn't going to do that, right? If we get to a model where the exchange says, yeah, I'm good for whatever for whatever gets stolen from you, and I have full sort of financial wherewithal to do this. Again, financial wherewithal, because the fact that they tell you their word is worth nothing to me. It's their action that I'm really looking for. Then yes. So the point is, if you just want to invest and you want to hold your little, digital stick with your Bitcoin wallet inside of it in your backyard, then that's what you should do. You shouldn't put it on an exchange. If you want to trade, then it's much better to go the CFD route. And the reason why is because the whole essence of trading is that you're not going to be, holding a position for longer than a day or 2 or 3. So your cost of carry is going to be minuscule relative to your security of counterparty risk. Does that answer your questions? Does that answer everybody's questions, Fabian?
Yeah, so far so good.
Okay. So, I'm actually even going to skip this question because really, who cares? Nobody's going to use Bitcoin to go buy their can of milk right now. So, but what is interesting is that when you're doing research, it's certainly worth watching all of these sites. There's a tremendous amount of information to learn. Reddit is a great website. It's great and terrible at both times because you get a lot of misinformation, but you also get some good information on there. But generally, if you really want to get involved, there's 1,000 different sites there. What I would caution you when you're sort of approaching crypto land is, even if you're the true believer, it really helps to be a skeptic, right? It really helps to be a skeptic to sort of not believe the nonsense. I think the single greatest danger in crypto land right now is every ICO offering there is, because it's essentially, it's not even Ponzi. It's not even Ponzi. This is the thing. It's literally legalized theft, because it's not like the in Ponzi. There's a sort of a honor amongst thieves where the money that I raise from the new investors, I'm going to give the old investors, so they at least so the earliest investors get money back. If you look at Bernie Madoff, right, all the earliest investors actually made their money back, and and the later investors got conned. So there's a modicum of distribution. This is just simply I give you my little daughter's paper cutout coin, and you give me $5,000, $6,000, and then somebody else decides to pay another $5,000 more for that, but eventually all they have in their hands is a crumpled little cutout paper coin. You're an idiot. I'm just telling you, you're an idiot to believe that ultimately there'll be value in an ICO. It is not a share of ownership. Once it becomes a share of ownership, once you have claim on an asset, once you have claim on a business, it's a completely different thing. But this is not a normal structure of how we used to do business, and that's why I caution you from it. So, what drives cryptocurrencies? Obviously, stability, specific news. Ironically enough, this is so interesting. I don't know if you guys have noticed this. I would say, in government regulatory announcements, blah, blah, so all the stuff that we're familiar with. But now I would say what's actually driving cryptocurrencies in some ways is FX. What's happened in the last, we're going to look at the charts right now in a few minutes, but hey, what's happened in the last few weeks? The dollar has gotten pounded, right? Although we're finally starting to get a little bit of a rally here this morning in dollar yen. The lower the dollar goes, the higher Bitcoin goes, right? It's actually acting as a store of value, right? Why? Because why is dollar getting pounded? Dollar's getting pounded because the world is starting to appreciate that in the end, Donald Trump always goes bankrupt, and I think nobody kind of understood how fast and how furious Donald Bankrupt is trying to bankrupt the United States of America. So people are starting to lose faith, not in the principle of dollars of fiat, but in the way it's being executed right now and managed. And so that's kind of fascinating and interesting as a hedging against dollar-denominated assets, right? Because if you were, so ironically enough, if you were to look at Bitcoin in terms of euros, it really hasn't risen a lot. Bitcoin, even in terms of Aussie, hasn't risen as much. But Bitcoin against dollar, because that's what it trades against, it's really popped off the bottom, right? So 3 things you need to know about cryptocurrency volatility. Bitcoin is actually less volatile than others. Even though it's more expensive, its actual intraday volatility is smaller, and you can see the volatility prints, and generally the volatility as we move through time and the whole sector matures, the volatility of the sector I think really becomes dampens significantly. It becomes to trade more like a regular asset than as a initial asset. Volatility generally increases when prices fall. That's true across all assets, as we saw that in the equity markets just a couple of weeks ago. And there's a lot of correlation. I'll even show you current market price. You'll see how everything is sort of very correlated in terms of movement. 70-80% correlation is not uncommon as far as the crypto land goes. So now we get, I think, to the interesting part of the presentation. The part that you guys are most probably interested in is, okay, we talked about the theory, we talked about the mechanics of it. How do we trade it? Because that's really what we're all about. How can we actually find actionable tradable ideas for cryptocurrencies? And there are 4 sort of strategies that we have, and then I have 2 very specific trading strategies that I'm going to share with you. One is, it's certainly, and this is true, I think, of the earlier mindset of crypto. This may not be as true now as it was before. Interestingly enough, the more mature an asset becomes, the less, what's the word I'm trying to, the less prone it is to breakouts. In other words, breakouts tend to happen because of market sentiment, right? The crowd moves one way, and the crowd tends to move in like a pool of like a school of fish, in a massive unison early, because nobody really knows anything. Nobody has a counterpoint of view, and everybody just moves like in unison, up or down. So breakdowns, very, very useful now, but I think they're going to get less useful as we go forward because the market matures and people are going to create more information about the product and therefore have more different opinions about it, right? Leverage on news, certainly, although news itself is a problematic thing. And right now, sort of the primary news is regulation, counter-regulation, and then maybe I think the next big wave of news, and it may take us another year or two to really see it, is use case, right? When are these things actually going to become useful in real life, and how useful will they become? You know, Ripple is making all these announcements about the idea of doing, you know, Western Union, wiring money across countries. You know, in the U.S., for example, it's a very, very big business. Ironically enough, I'll tell you, I have a friend who is essentially very much involved in that business. The business of expatriating funds, right? We have a lot of immigrants in this country who send money back to their initial countries, certainly like billions of dollars to Mexico, but also billions of dollars to Philippines and other places across the world. And so the way these guys really rip you off as a consumer is, you know, they charge you a fee, which is extraordinary in some cases, sometimes like 5 to 7% of the, you know, face value transaction. $1,000 costs you $70 just in fees, right? But, and this is what Ripple is trying to eliminate. Ripple is trying to eliminate this massive overhang fee because they can make settlement much better, much faster, which would be great. But the other way these guys really screw you is currency transaction, right? Because they got to convert. Excuse me. Let's take the case of just dollar to Mexican peso, right? What they do is they use like what I call the airport conversion factor, right? We all know, because we trade FX, everything trades within, you know, 1/10 of a pip in real world, right? Even if you were to take, let's say, 10 pips for currency conversion, which is more than enough, you know, you would be okay. But these guys take 1,000 pips. They take a full dime, you know, on the back end. So not only do you get screwed by, you know, by transaction fees, but by currency transactions. So a lot of that stuff is very useful. You can see the potential huge business case for somebody saying, well, you know, I'm just going to send Ripple one way or the other. There's not going to be any currency conversion. There's going to be very little fees, and the end user, the $1,000 you sent to grandma in Guadalajara, is not going to be $700 when it finally ends up to her. It's actually going to be $999 and, you know, and 10 cents. That's massively positive. So we're going to be watching for all those kind of news that way. So you know, the other way, of course, obviously, is riding price reversals, which is what I'm going to talk about, and also buying very low. Now, what does buying very low mean? That's obviously a very subjective term, but I'm actually curious. Another question I want to pose to the room, Fabian, see if anybody answers. Did anybody step up and buy Bitcoin at 6,000? You know, are there true believers here who bought below where we're at now, who really, you know, who made bid when we were really bleeding into you know, into posterity here, because that's sort of the kind of, you know, wild volatility swings you need to do if you want to establish good basis positions for longer term, you know, contracts. Nobody?
Yes, we had a couple of people between a couple $100 to a couple $1,000 sort of buying around them.
Good for them. So good for them. So now they look intelligent, and it was probably a very decent trade at that point. So two main ways of buying. We can buy the underlying, which I'm completely dissuading you from doing, unless, again, as I said, unless you are a hardcore investor. You know, it's the same thing. Do you want to buy the Van Gogh painting and then just hold it in your basement for years and years and years, which is one intelligent way of possibly making money, or do you want to trade the CFD on Van Gogh? I think that's the next. I think that's Fabian. That's what we should do next. Pepperstone should really, you know, do fine art CFDs. We just trade how people feel about Van Gogh versus Monet versus Manet. You know, all of my favorite artists of the world. That would be a really interesting CFD to imagine. But obviously, I'm being facetious here. But contract for difference is the way that I think is to do it. Now, you know, we're kind of running short of time, and I've gone through all of the cons and pros of all this stuff. Let's get to the meat of the trade, because I'm sure you guys are interested. How do we really trade these things in an intelligent fashion? How can we apply good old-fashioned trading techniques to try to make money out of cryptocurrencies? So the first strategy that I want to introduce to you, and by the way, all of this is written down. It's in the PowerPoint, so I'm sure you guys will have access to the PowerPoints. So I'm not going to go through too much on the rules, but they're all written down. But we're going to use the Bollinger Bands one of our favorite techniques to ascertain intelligent entry points on the chart of when we have the highest probability of success of directionality. And so here we're going to use 20 and 2 standard deviations, 21 standard deviations with default 20 period, right? All of that stuff. And what we're going to make is our following rules for, first I'm going to show you the longs, and then I'm going to show you the short rules. So on the long side, we're looking for the close above 1 standard deviation in an uptrend, right? That's the first rule. And I'll show this on the chart and you'll see this. And then we are looking for the 2 prior candles where the close, not the high, the low, but the close is below the 1 standard deviation, right? So what we're looking for is a break up into the 1 standard deviation. And we're going to buy at the market open. I'll show this to you on the daily charts where you really see this nice and clearly. And then we can go on a 240-minute chart as well. And here, it's up to you to how to create money management techniques. But this particular strategy is designed for the idea that if we get a breakout, it could be significant. So if it's significant, what we want to do is try to milk the possibility of a large move. So what we do is we set the target on the, it's a two lot entry, 2 unit entry. The first unit, the target is 1/2 the times risk. And the second unit, you can just simply trail. You can trail either by, high low of the day, 20 SMA, or however you want to do it. So when the first unit is closed, the rest of the trade is moved to break even, and you just try to trail it up. So I'm going to stop right now on this particular trade, and let me just show this to you visually, because I think it's much better if we deconstruct these things one at a time. So here I have the Bitcoin chart, right? I'm going to zoom in. Everybody sees my Bitcoin chart pretty sharply, right? Is that correct, Fabian? I just want to make sure that you guys see it very, very clearly, right?
No, yeah. Okay, here we go.
Yeah, okay. So very important. So you see my Bitcoin chart. And by the way, sort of, Kathy's point to the correlation, you can see Bitcoin, Ethereum trading, they actually came off, man, this was trading 9,900 before we started the webinar. Now it's trading 9,700. They still, Dash is a little bit lower, but you can see Ethereum is up as well. And we can lay them all down on the chart, because it really doesn't matter which asset we're looking at. It's much more the mechanics of the trade that really matter in this case, that hopefully you guys will find interesting. So here's the Bollinger Bands. This is a daily chart. No, sorry, it's a 240-minute chart. 240-minute chart. Let me go to the daily chart. Let's start with the daily chart. The problem is Bitcoin has been in a completely... Okay, so here's a good example of the long example that I try to show you on a daily chart. So here's a daily candle, right? This is the 1 standard deviation. This is the 2 standard deviation on a daily chart. The 2 prior candles are clearly well below the 1 standard deviation. Here we have the move into 1 standard deviation, right? The close is 72.94, and the Bollinger Band 1 standard deviation upper band is 72.37. Let me just sort of show you. I actually can't show you. You see how BB20 close 1, 72.37. That's the value of the Bollinger Band, and you see how the close is 72.94. Hopefully, all of you see that. That confirms the move is through the band. End of the day, boom, boom, boom. We got a signal. We're going to go long, right? Now, how much do you want to risk? Generally, I like to risk sort of I always like to enter on indicators, but risk on price action. What I mean by that is, if I break the low of this particular candle, so the low of this particular candle is 6,600, right? So I'm going to put a stop at like 6,500, just for argument's sake. So my risk is 7,300 minus 6,500. Risk is about $800, right? So what I want to do is I'm going to go long at $7,300. I'm just rounding out so you guys easy to follow. I'm going to put my first exit at plus 400. Remember, my total risk is 800 points or $800. Now I'm going to put my exit at $400. So $7,700 is my exit. Now the next day's candle, the high is 7,900. So at 77, I've made my target, right? I made my exit one. I then put my stop at 7,300, right? Let's assume I don't get tripped. Is my 7,300 stop tripped? No, because the low here is 7,500. Is it tripped over here? No, the low here is 7,400. Is it tripped over here? No, the low here is 7,600. Is it tripped over here? No, it's 7,900, right? Is it tripped over here? No. And by the way, look at the highs. Now I'm at 83, right? I mean, it all depends. It all depends on how you want to just try to milk it. In this particular case, you probably could have milked this significantly. I'm still surviving my stop on the second unit, right? And obviously, if you took this ride all the way, you could have made 2,000, 3,000, 4,000 points on this, depending on how you wanted to do it. I actually prefer not to trail my stop, but to exit my stop on the pierce of the Bollinger Band. So in this particular case, I'm able to survive my stop, right? I'm holding the second position, the second unit, and then when it just kind of pierces the Bollinger Band to the upside, sort of a extreme move. I'm early. There's still more juice to come. But even if I get out of this, like at around high here was 11,000. Let's just say, for argument's sake, I got out at 10,000. I made 400 on the first unit, and I made 2,300. I'm sort of being very conservative here. 2,300 on the second unit, right? Risking 800 in my initial position. So that's pretty good trade, and it's the only way that I know of. It's the only way that Kathy knows of how to stay in a trade for a long run. You need the psychological relief of taking some money off the table, and then you can just let the thing run. And this idea is really designed to let the thing run up, right? So now let's just bear with me a second. Let's look at it to the downside. The downside rules, which is what we're looking now, and this is very important. Here I'm going to show you. I'm actually very interested in showing you this particular example because it stops you out, and this is where risk control is so important. So look at this chart over here, right? Here are two candles. This is the one standard deviation to the downside. So the short is the exact opposite. We're coming down. We want to sell once it pierces the one standard deviation, where once it begins to signal a possibility of trend, right? Now remember, sometimes the signal is false, right? Sometimes the signal is false. Indeed, it is. So what we want to make sure is to protect ourselves when we have a false signal. So in this particular case, you can see these two guys. They are not. This one, probes the one standard deviation, but it actually closes above it, right? So that's not a true signal for a short entry. This one legitimately closes below one standard deviation. The signal is here. The close is 13,900 for argument's sake, right? The high is 14,650, right? So about 700 points, 750 points above the entry is my high. That is where I would set the stop. That's where I would set the stop, and I would get stopped out, right? And I would be glad to be stopped out because if you look at it, the tear up was actually much higher. So I get stopped out at 14,650, and this thing goes all the way out to 16,000, and then it actually even goes out higher to almost 17,000, whatever. The point is, and the thing is that at this point in time, right? It's easy to say, well, it eventually came back and sold off, but at this point in time, you don't know that it's going to sell off. What is much more likely, actually, is that it's going to just verticalize even further. And this is why you have to have very rigorous risk control in this particular trade. So this trade, I'm stopped out, but I'm down, but I'm not out because now I have a secondary attempt to come back into the trade. And now, so I get stopped out. I'm patient. I watch these two things. They're outside. This one finally nudges myself back into the trade, right? So I'm short here at 14,340 with a stop at around 15,100, right? And so that's 800 points worth of risk. So I'm gonna go for 400 on the first move, and of course I get that. And then it actually even it actually even exits out at the Bollinger Band. And if you were using my method of just exiting out on Bollinger Band, you could have banked the second unit as well. But the point being is that this was a successful trade, and it made you minimum 400 points and maximum maybe even 1,600 to 2,000 points in a single day trade because you timed it correctly. This is really all about making sure that you time your entries correctly, and then you manage your money when you time the trade, right? We have another fall back into the into the band over here. Now this is where, and the other key point that I really need to stress is that you need to trade this at low leverage as possible, because you need to give yourself a lot of times the ample room for the trend to develop. Here's a good example of why I like to use price points, not indicator points, as my stops, because you want a true stop, not an arbitrary stop, but a true stop. What's a true stop? A true stop in this case obviously would have been the high of this candle, which is 15,000, for argument's sake, 14,900, 15,000, right? Now you have 2 days of suffering when the thing actually goes against you, right? No, I was just thinking that maybe you could make it, maybe make unit one profit, but you couldn't. So you have 2 days of suffering where it retraces back against you, but does not take out the 15,000 high, right? And because you're able to survive the stop, the trade actually turns out to be a really good one. And then it starts to finally pick up trend, and then you're finally able to actualize the profit. So very, very important to have these two components of the mechanics of the trade working for you, which is that you need the entry, you need the proper price stop, and you need the money management technique of how to run it. Okay, so that's that's one way of doing it. And of course, to minimize risk and to optimize opportunities, you want to go down on a lower time frame. I think you could probably even trade this on a 1 hour time frame. You're going to get a lot more false signals, but it's going to cost you a lot less because the range of motion is much smaller. So you have much smaller targets here. It's not uncommon that before a trend starts, you get a lot of false starts, right? So here's a false start. You go long here, you get stopped out, right? You can't be dissuaded. This is the most important thing that I sort of want to express to you. You can't be dissuaded if you get stopped out a couple of times, because what you're trying to do is find the trend, and the trend is not easily identifiable, right? It takes sometimes a couple of efforts to find it, but this is a great way of finding it, because, okay, I got stopped out on this one, I come back in here, right? And the second time I come in, the trend becomes much more genuine, and it starts to really move up and go up on the charts. I think 1 hour is just too volatile to trade Bitcoin on, because the spreads and the volatility in Bitcoin probably don't pay for the 1 hour chart. But a 4 hour chart is probably a good compromise between the infrequency of daily and the inaccuracy of the 1 hour. And using a 4 hour chart, you get a lot more sometimes intelligent signals here. I just want to look at the chart here for a second. You have you don't even have a false signal a couple times, because all of these signals get done on what I call unit one. So short exit on this one, short exit on this one, positive one, right? You go to break even. You would get a stop out over here, a small stop out over here, because if you trade it to the short side, and then right back up right over here. Here's your signal, short exit here, right? And then a second signal, which now becomes possibility of a nice long run, right? Everybody can see this on the charts where I'm showing this to you, because if I'm coming over here, I definitely get my short signal exit over here at half risk. And this time I come in, it finally picks up steam, and it gives me 4, 5, 6, 7 240-minute candles where it trends. So I'm able to bank money on my short exit, and then hold on to my second exit and try to make money as it goes, as it goes up. So that's strategy number one. We're kind of running out of time, so I just want to make sure we get into strategy number two. Okay. Any questions on this, by the way? So let me.
Yeah, one quick question.
Yes.
When you say you take your profit or half your profit, like your $400 first target before, is that structured in 2 trades, or are you literally closing half a trade?
No, it obviously depends on how you like to trade, in terms of if you're trading with an EA, or if you're trading point and click. The simplest way to understand it is just simply think of it as 2 trades. Yes. So you have 2 units, right? The first unit has a short exit, like a $400 exit, and the second unit doesn't even have an exit, or maybe it has an extraordinarily long, like 3 times risk. That's another way we used to like to do this. Let's say I'm risking $800, right? So then I put a extraordinarily extreme exit on the second unit of $2,400 exit, right? That would be like, that would be my way of doing it. The moment I make money on the short exit, I move the stop on the second position to break even, and then I don't have to look at it, okay? Or I look at it, once every 16 hours or so. Does that make sense to everybody? Is that clear?
Yeah, we're good.
Okay. So now the second way of trading price, and this is a RSI turn on the 4-hour charts, is again same idea. We're sort of using indicators, but we're going to use prices. In this case, it's the swing highs, swing lows that we're going to use as reference points to put in what I call true stops to the position. So here we're just simply looking for the RSI to obviously go into the extreme zone, and only when momentum drops off, only when the RSI leaves the 70 zone to the upside, and on the short side, we're looking for it to come down to below 30. Do we wait for this? It's actually it's funny. I just realized that Kathy, if you don't mind, I'm actually going to. This should really short trade, not a short trade. It's a short trade. The logic here is it's kind of funny. It's flipped. I think I know why she typed this out. It's funny. When we're in the overbought territory, right, we're thinking of it as it's moving up, right? So the idea is a long trade. But what we're actually doing is we're fading the long move. We're fading the short move. We're looking for the inflection point of when all the longs are done or all the shorts are done. And then, and we're using swing highs, swing lows to put our targets on. And here we're only using a single unit structure, where we're going to use one-time risk as our trade. Let me show this to you on the charts so that you guys can see how this works. And the RSI here is on the bottom, right? So let's we actually I think, well, if we assume the 4-hour close, if this closes as is, we'll probably have a signal. So let me give you some theoretical. Let me see if I can find it first. Well, let's do the long. Let's do the long signal, right? This is a good example. So RSI is below 30, as you can see, right? Whereas the RSI value is 21, right? It drops down below 30, right? What we're looking for is for the RSI then to come up above 30. In this case, you can see 21. Then it comes up now. Now the RSI value is 30.57. We're above 30, right? What is our stop here? The stop is not this particular candle. It's not the RSI value. It's the terminal short, which in this case, the terminal low of this particular slice of price segment, which is 59.20. That would have been the God. What a great price that would have been to buy that. But we don't buy it at 29.20. But the point is, our stop is 5,900. That's our stop. That's about as good as entry as you could get. So we're long on this candle, the close of this candle, which means that we're long at 6,500. Right? I'm averaging up just to make prices real. So I'm long 6,500. My stop is 5,900. Let's just maybe even make it 5,800. Let's just say my stop is 5,800. My entry is 6,500. That is a 700-point risk. So I'm long at 6,500. I am exiting at 7,200, which, by the way, is done the next day, right? Can you do this in a one-two structure that I showed you on the other trade? Absolutely. In some ways, it's almost superior. I mean, you're not going to get a lot of these perfect inflection points because otherwise we'd all be super rich if we could all pick the inflection point perfectly all the time. But when it does inflect the way it does, it can actually really make you a lot of money. So if you came in at 6,500 here, right, and you exited one times risk and you put your stop at 6,500, you could have moved this all the way out to 8,000 to the Bollinger Band opposite before exiting the trade. That doesn't happen a lot, but it does happen. Here's an example. Let's just take a look at like a good example of the trade. And this is where you certainly have to have judgment. Every one of strategies that I show you is a general framework for making profits. It is by no means the absolute framework for making profits, and it's certainly by no means a guarantee of making profits. What I mean by that is it's a general framework for the highest probability entry of a position, but it is by no means the only way to exit. You have to use some common sense. This is a great example where you would really need some common sense, right? So here we are. RSIs are all, below 30. Here we have a big pop-up candle. It goes to 39, right? So first order of business is this is a lot of risk. There's a lot of risk, right? Because what's the rule of the thing? Our rule is that we're using the terminal low. The low at this point is 7,600, right? So I'm in at 9,000. My stop is 7,500. Thus I have a 1,500 point stop, which means I'm looking for a 1,500 point exit. Is it worthwhile for me to take that risk? I'm not so sure, but let's say I do. Let's say I do, right? And I'm in the trade, and the trade goes 1 day, or one 4-hour period, 2 4-hour period, 3 4-hour period, 5 4-hour period, right? And now I'm mildly positive, right? So I'm in at 9,000. Now it's back to 9,000. Then it gets to 9,500. Remember, my risk is 1,500, right? Then another period where it's 9,300, right? Here, I'm like, you know what? I've been in this position for 6, 7 units of time. That's a very long time for this thing to turn. And I'm not going to risk my capital. I'm going to move my stop to break even at this point because I'm not, because if this thing turns, I have a risk of getting stopped out completely. What I'm looking for at this point is it's either going to gun up or I'm just going to abandon the trade for no loss. That's how I would trade this. That's how I would use common sense judgment. If you're in a trade for 4 or 5 units of time, whether it be days or hourlies or even or 4 hours or even hourlies, and you're not getting the turn that you're looking for, then you want to protect you. At that point, you're thinking about return of capital, not return on capital. You're thinking about protecting your property, right? And that would be a much more intelligent way of trading. I'm dying to find. Okay, so I guess here I found some longs, right? I want to just show you one long example. So this is interesting. Let me see if I okay, let's run this because I haven't looked at this chart. So let's just run this chart. So 73 on the RSI. The next RSI drops to 67. My terminal long here is 17,200, right? And I'm in at 16,500. So about 700 points worth of risk, right? 700 points worth of risk, right? So I get short, and I'm looking for about 700 points worth of risk, and it 3 or 4 candles in, and I have about 500 points, right? I came in at I only have about 300 points, 300 points worth of profit so far in the move. My stop is 17,200, right? I'm staying in the trade, and I think I get. Let me see if I get stopped out. Yes, and I get stopped out over here. I get stopped out. That happens. As I said to you, you're not going to pick the top every time. And in fact, you're going to have several false starts. You have to anticipate the fact that your first entry could be the false entry. But don't despair. This is the key thing. So I get stopped out by, a millimeter. Maybe, if you were super smart, you said, I'm going to put my stop at 17,300, and this one goes to 17,234, and you avoid the stop. Maybe you're smarter than me, but let's just assume I get stopped out. So I get stopped out, right? This trade is back up to 70. The very next trade, again, I lose momentum, right? The very next trade sends me a signal that's worthwhile taking. Don't ignore that signal. That's actually really good signal. So now I'm short at 16.7, and of course, it just goes down like a stone, right? So the key thing to all of these structures is to understand that they're looking for inflection points, either for trend points or for turn points. They don't always work perfectly the first time, but they work over time. And if you use proper money management, good techniques, and sound judgment, they put you on the right side of the trade when you're trading the cryptos. That's the key thing that I just wanted to communicate to you when you're looking at all this stuff. Rules are very important. but judgment and context is just as important. So be aware of all of those things when you're trading them. But overall, these are battle-tested, rock-hardened, really great ideas that, and just sort of, to show you why they're great ideas, you can see that, when you're below the 70s, right, you're going to get a lot of false moves. You're going to get a lot, maybe over here you get, I don't know where you would have chosen to get short trying to pick a top, but maybe you would have gotten lucky here. But a lot of times, when you don't get the extremes, the retrace is super shallow. You certainly don't get the kind of what's the high from here? 16.7, and the absolute low here is about 3. You certainly don't get the kind of 3,000 point moves. If you're risking $500-600 on a trade, right? You're not getting you don't get the prospect of a $3,000-4,000 payoff on part of the trade unless you pick the extreme turn moves using the RSIs. That's the most important, interesting aspect of all of these setups, is they put you into the possibility of a really large payout on part of your trade. Okay, I'm done. As always, I never seem to fail to go over time. I'm glad you guys hung out with me. Feel free to ask me any questions. I'm happy to answer anything that you guys have on your head.
One, and a lot of traders seem to have a problem with this, is that with CFDs, you can generally only trade them 24/5, so you tend to miss out on the weekend. Would you say that trading on the weekend, or the opportunity to trade on the weekend through an exchange, is a bigger value, or being able to short sell and use leverage sort of covers that fact?
I don't think so this is my personal opinion. You're welcome to disagree, but I think if you've watched crypto on the weekend, there is nothing more volatile, less predictable, and harder to trade than crypto on the weekend. Crypto on the weekend is when all the crashes happen, right? So yeah, it's brilliant if you pick the top or you pick the bottom on the weekend. My point is, everybody needs a break. We all need a break. Nobody is a bigger market junkie than me, but yeah, I suppose if the weekend is the only time you want to trade, maybe that's your domain. But it's a completely different market. It's much more volatile, much thinner, and much more manipulated. I mean, God, I've never seen a bigger manipulated market in my life than the crypto market on the weekend. So the short answer is no. I like to trade in a standard protocol model that gives me that gives me lots of possible profit opportunities over a long period of time, not just, wham, bam, thank you, ma'am, on the weekend. Let me see if I can score 1,000 points on a Bitcoin retrace, which happens within 1 hour, at 6 o'clock in the morning, New York time. And then it retraces everything in 1 second flat. All of you guys who've watched crypto on the weekend know exactly what I'm talking about. So yeah, the answer is there's 5 days to make money. Use those 5 days productively, and definitely use the CFD as a proxy, because the benefits so far outweigh the risks, in my opinion. Not to mention by the fact, I think the fees that I hear people get charged every time they're on Coinbase or anywhere else are actually enormous. Yeah, you could make bid ask if you're lucky, but you won't a lot of times. So anyways, my point is, I like the idea of applying conventional trading techniques to crypto instead of trying to do everything new. It is an asset like any other asset, and it's finally starting to trade like any other asset. And it's actually all the more reason to use it on CFDs, because the more normalized it becomes, the better it is to trade it under normal market institutions. So that's my answer to that. Any questions on the strategies? Anything else? I'm happy to answer.
Thanks, Boris. Most of the questions were people just trying to clarify the points, but we can just send them the replay, and they should be able to pause it and go through that.
Yeah, absolutely. Plus, I'm sure, I think you will, the actual PowerPoints, the PDF of the PowerPoints will be available to you guys. And the rules, therefore, the rules of entry and exit are all there, and you can slowly go through them. My best advice to you guys is to just spend a little time with the charts and just familiarize yourself with the setup of how would I have traded this? What is the proper thing? Do that about 10, 15 times on various charts, and you will internalize the setup. Once you internalize the setup, it then becomes a lot easier to spot it in real markets and then trade it on small size to get comfortable with it. Okay? That's my best advice to you. Thank you so much again for hanging out with you. I hope you guys enjoyed the crypto presentation. And of course, I'll be back to you guys next month, hopefully if I'm standing here. And we'll have some other great topics for you. Take care.
Thank you, Boris.